You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me. It's always good to talk with you.
In Canada, our governor of the Bank of Canada has hinted if things don't go great for the economy, he might bring in negative interest rates. Meanwhile, the Fed is talking about hiking rates. How come we're getting two different messages here?
Well, I really can't speak to what's going on in Canada, but I'm not really following it closely enough. It sounds kind of surprising that they would say that. I had no idea that things were that bad there. But here in the United States, the Fed has kind of trapped itself and has put itself into a box over the past year where they almost have to raise, well, they do. They pretty much have to raise rates next week because they've been talking about doing it for so long, and for them not to do it at this point would cause people to wonder and worry that something is very wrong that they know about and that the rest of us don't. Now, that said, there's a lot of people who are worried that an interest rate hike from the Fed could be destabilizing for the stock market. We've seen some weakness in the stock market over the past week. Not huge, not enough to really be that alarming, but it does look to me, I wouldn't be surprised if we don't see the market dip a little bit more into the Fed meeting and then possibly have a little bit of a bounce or rally into the end of the year as people kind of buy in relief. And actually, I wouldn't be surprised if when that Fed interest rate decision comes out, if they don't actually release a statement to reassure people that they're not going to go crazy raising interest rate hikes and are going to be very slow and very deliberate, try to say something dovish to soothe people's nerves who are nervous about the stock market, and that could also cause some sort of rally or bounce into the end of the year. That said, though, I'm not really looking for some giant rally or breakout. Many people are. The stock market has really been in a very narrow range all year long. The S&P 500 went up to about 2125 in May and in July, and it's now at 2050. We did have a tumble in August, but if you ignore that August move, the market really has done absolutely nothing all year. In fact, it's almost exactly right now where it was 2 months ago to the day. And it's like there's like two groups of people, it seems to me, people who have either fallen asleep when it comes to their investments in the stock market because it does seem like nothing is really happening. It takes big swings to wake such people up. And then there's people who are very bullish on the stock market who just assume it's going to eventually break through those highs and just take off and explode. And I've watched, the financial news and internet commentary, and I see people that when the market has an up day, they start to get very bullish and excited, and there's been predictions all year for this big, giant breakout to happen. So right now, there are people who think that such a move is going to happen at the end of the year. So if we do get some sort of bounce into the end of the year, which I think is very likely, there'll be people coming out everywhere to say that's the time to buy, that everything's just going to go to the moon and take off. And look, the Fed raised interest rates 1/4 point, but they promise they're not going to hurt anybody and they're going to do any more interest rates very slow. Look, it took them years to just do this one, so don't worry about anything. In reality, though, there's all kinds of trouble signs, and I think they're going to hit the market almost as if you took a nail and started whacking it with a hammer. I think that's the situation the stock market is going to be in next year. And there's two things that I think are concerning. One is I know something that we've spoken a lot about, and that's the technical condition of the stocks and sectors inside the stock market It's only a few stocks that have basically held the market averages up all year, about 24 stocks like Nike, Activision, Facebook, Google, Amazon, stocks that have gone straight up. But besides those 20 or so stocks, the S&P 500, most stocks haven't done anything and actually are down year to date. Over 50% of the stock market, if you look at all 5,000 stocks that trade on one of the three major U.S. stock exchanges, are actually down 20% off their highs. So it's a market that the averages seem okay because there's a few momentum stocks that everyone has seen on Fast Money and CNBC that have just gone straight up, but the average stock has been a very poor performer. That's something we've spoken about many times, and that's what happens at the end of a bull market or the start of a bear market. So it's a very disconcerting sign. Now, there's another thing, and I do think it has to do with the Federal Reserve, and people have this perception, and it's going to return again after the Fed meeting if we do get a bounce, that the Fed wants the stock market to go up, that it makes the stock market go up somehow. I get emails from people who say the Fed manipulates the markets and does this and that, and they'll never let it drop again. But the thing is, people believe that in 2000, people believe that in 2007, and of course we all know what happened then. But more importantly, and this is what I think I'd like people to get out of this conversation is what actually did the Fed do over the past couple of years to help make the stock market go up? It's not that the Fed goes out there and buys stocks directly, but its policies have helped create, over the past couple of years, a boom in something. If people follow Austrian economics, which talks about boom and bust cycles and Fed interest rate policy, if you're a student of that school of thought, and the person who's really, I think, brought that to people's attention the most is Ron Paul, when he used to talk to Alan Greenspan and Ben Bernanke on television. But one of the key concepts of Austrian economics is that when the Fed artificially lowers interest rates, it creates a surge of money somewhere in the economy that goes into something, and it leads to a misallocation of capital. Artificial interest rates create lending that wouldn't be happening, or borrowing that wouldn't be happening if interest rates were at a natural level, a level that made sense. So right now, interest rates make no sense. You know, if you've got money in the bank, you make nothing. You know, how does that make any sense? It shouldn't be like that. You know, anyone who's got savings in the bank should make something off that, and the banks themselves should make more money lending money than they are, but that's not how things work, because interest rates are set for the banks by the Fed, which has them at zero. And such policies helped create the internet boom that went bust. That was the bubble effect in the late 90s, and then, of course, the real estate bubble happened after that bubble went bust. The point is, when the Fed has rates artificially low or prints money or does some policies to put money in the economy, it goes into something that inflates and blows up and turns into a bubble, and then you get the bubble bursts and you get an even bigger mess than before, and the Fed does this over and over again. So this is essentially what's happened over the past couple of years, but how? Well, when the Fed began its quantitative easing programs in 2009 and then in 2011 and 2012, it bought Treasury bonds off of the market and other bonds and mortgage-backed securities, and it kept rates really low, and that made yields also for junk bonds and corporate debt drop too. It made it easier for corporations to go borrow money. And if you look at the statistics and data, starting at the end of 2012, corporations went on an orgy of issuing bonds and debt. The junk bond yield for low-grade debt was 2%. Today it's 4%. So the corporate debt bond market is weakened. But back in 2012, the corporations were able to borrow money even the worst of them from it's nothing. If you travel to Las Vegas, you'll see all this construction that's taken place over the past couple of years. They've renovated it. They've changed Imperial Palace and turned it into something else. There's another casino next to it that they totally remodeled. They built this giant Ferris wheel. They're now renovating the MGM. While the number of visitors isn't really growing and the amount of revenue this place is making is barely going up, but all these companies based in Las Vegas decided that was the time to do capital investment, and the casino industry is just blossomed and boomed all over the United States and building casinos, but the stocks for the casinos have all been going down because there's so much in debt, and it's kind of a mess. Their revenues haven't grown to keep pace with all the borrowing they've done. If you look at Wynn, W-Y-N-N, it's one of the worst performing stocks in the entire S&P 500. Now, here's what's really happened to help make the stock market go up. Corporation in the United States borrowed money by issuing bonds and then used that money to buy back shares of stock, therefore making the stocks go up. And then they started doing this in a big way in 2013 and 14, and that's what really created the giant stock market rally. Now, what also happened, of course, is some of the CEOs took advantage of this to dump their own stock as they were using their companies to borrow the money so that they could line their own pockets. But that might be something that people will get mad about after the next bear market. But we're at a point now where this is really important because this year the corporations still did this, but they weren't able to make the stock market go up that much anymore. The S&P 500 is barely up 1% year to date, even though the corporations are doing all this buying. Now, they can only go in debt so much, and the junk bond yields are starting to go up, making it more difficult to borrow, and a few points of a tighter Fed or even 1 point may be enough to unglue the whole junk bond market next year. So all this kind of borrowing and buybacks, or borrowing for buybacks, will basically come to an end. And this has been the fuel, the bubble fuel that's made the stock market go up, enabled by the policies of the Fed. Just as it helped create the bubble in real estate, internet stocks, now they've helped create a bubble in corporate debt that's generated buybacks and made the stock market go up. So this is how the Fed has helped the market, not through direct manipulation, but a side impact of their quantitative easing and low rates. And this is all going to come to an end.
We'll have more with Mike Swanson right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. See singing impressionist Andre Philippe Gagnon.
And I think to myself,
In Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Mike Swanson. Mike, what's going to happen when people find out the 7 to 9 year car loans aren't worth paying anymore because the car isn't worth the amount that they're paying for it?
Well, the banks will repossess the cars if they don't pay on them and get what they can for them. That's about what happens. It depends on what kind of car dealership you're going to. The real low-level car dealers, they've got loans set up so basically, it's almost like going to a high-yield lender or a money center or something and signing over your life if you don't have the credit or income to get a real loan. So it's kind of a crazy business. But, a lot of the loans that have been made for, mainstream Americans, the loans packaged up and passed on elsewhere and so forth. But the good news about these kind of loans, though, is they are short in duration. You're talking 5 years and so forth. So I don't think that in itself will really create a giant problem.
I know some people are worried because, most homes appreciate in value. And, of course, a car loses $5,000 or something the second you turn the key, where, they'll just say, yeah, take the car away. It's cheaper to get another one. And a brand new one. Also, what about the new technology? GM is bragging about so many of their models coming with Wi-Fi, but by the time you finish paying that 7-year loan, how out of date are all those electronics going to be?
Yeah, that's a very good question. Goodness, I mean, I've got a car that will be in that situation too. But, you know, I don't think the Wi-Fi stuff will change too much, but some of the capabilities of it will. I mean, my car has built into it one of these map systems. I mean, who knows if that'll work when it's time for someone else to drive it. So that's a big problem. I guess they'll have to, you know, do something and change the computers if things get changed but so much.
Google's, of course, talking about making a self-driving car. I think Amazon's in that league as well. But I haven't heard anything from the big car makers about coming out with self-driving cars yet. Will they be left behind?
I don't know. I saw a story about the Google car that it actually wrecks a lot more than a normal car would do. So I'm personally scared to get in something like that. I like the old-fashioned way of where I'm driving the car. I don't really want to trust the Google computer. And certainly right now, the statistics are it wrecks more than it doesn't. I think the only way they're going to get everyone into a self-driving car is if they make it the law, and hopefully things will never come to that, but who knows, that may be way off in the future one day.
Yes, and of course they never tell you about the wrecks. All they tell you is, well, we haven't received any tickets. But that doesn't mention the thing
right.
deciding that, a telephone pole is a good place to park.
That's right. Well, I mean, it is scary because I mentioned I've got one of these map systems in my car, but it barely works. I mean, if I drive out of town and use it, sometimes it'll think I'm a mile away and it'll be telling me to go all these crazy places and I don't know where to go, and it's a total disaster. So these systems aren't really as reliable as they're made out to be. And in the end, I mean, I've never looked at a map and it gone, in circles looking at the map, but the computer will make me do that.
Yes, and of course, you know about your own personal computers. They don't always work right either. And what happens when you're doing 60 miles an hour down the highway and your computer decides to reboot all on its own?
Yeah, well, that's a good question. And there's, I don't know if it's true or not, but there's some story a couple years ago of some reporter that was in a car accident, and there's this people claiming that the computer just blew up and caused it to happen, and this and that. But I mean, who knows what really happened there? But it's definitely interesting stuff. We all benefit from technology. I mean, we're speaking on the phone right now. We wouldn't, as far as investing, we wouldn't be able to do the type of trading and analysis when it comes to the market like this, say, back in the 80s or early 90s even. So, the thing is, though, there's a flood of information when it comes to investing and using the computer, and you've got to narrow it down to what's important and what isn't. And that's easier said than done because, we're flooded every single day with news, stock market action, this and that, and the bulk of it really doesn't mean much in the long run. So if you just look at the stock market now, we had the Dow was down over 200 points just the other day, and then it gave all those gains back. Then it went down yesterday, now it's up today. Which of these days is important, which isn't? The bulls see the up days and get all excited and dream of the breakout, and then on the down days, the bears start to think it's all going to crash. In reality, at the moment, I don't really think a whole lot is actually happening in the stock market, but that'll most likely change next year because that situation doesn't continue forever.
And I was going to say, too, this holiday season, we had things happen in August when normally you have big adjustments in September or November in the stock market or October, but not in August. So if something does happen, could it happen earlier than expected? Don't wait for the new year. It could happen around Christmas.
Well, I do think there is a good chance that the market could have a drop into the Fed meeting that takes people by surprise because people are pretty much, as a whole, right at the moment, either very bullish or very complacent. And S&P is at about 2060 at the moment. It could easily fall to 2,000 or below that and shake people out a little bit. In fact, last year it kind of did that. It had a drop about in the middle of December straight down, and then rebounded really hard into the end of the year. So there is a precedent for that happening. It wouldn't be too shocking at this point.
Mike, thanks a lot for chatting with us.
Thank you. Good to talk with you as always.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.